Welcome to the FitBiz Accelerator, your ultimate guide to launching, growing, and scaling a thriving online fitness business. I'm your host, Tobias Young, and whether you're just starting out or looking to take your business to the next level, this podcast is packed with actionable tips, real-world strategies, and the insights you need to crush your business goals and build the business of your dreams. Now that you're here, let's dive in. Welcome back to the FitBiz Accelerator Podcast. Today, we're going to be talking about something that every trainer, gym owner, and online coach needs to understand. Making more money is not the same as building wealth. My guest is Phil Calandra, and he's the financial strategist, and he's an author of True Wealth Advisors, and he's a partner at Appello Wealth, which is a $10 billion advisory firm. And Phil helps seven-figure founders coordinate tax strategies, business cash flow, and personal wealth into one clear plan. His clients actually average $48,000 in first-year tax savings, which is insane. But Phil's story is personal. In March 2009, after 25 years in financial services, he actually found himself with 8 cents in his business account, his payroll, that was due the next morning. And he rebuilt and he exited 2 different businesses and he reached work optional status where he doesn't have to work. And Phil, welcome to the show. If you can, tell us back at that moment when you had 8 cents in your business account, how did that happen and what did it teach you?
Yeah, buddy. Good to be with you, Tobias. It took me a long time to not be ashamed of that, to be able to tell this story. And everybody has a money story. And mine was as painful as it possibly can get. In March of 2008, or the year before the financial crisis, I made $1 million net income. 1 year later, during the financial crisis, March of 2009, like you read there, I had 8 cents in my business account. The market crashed. And as a financial advisor, obviously, those were no bueno. It was not a good time. And I had the payroll. I was heavily in marketing. I had a radio show here in Atlanta. I had a TV show here in Atlanta. I had everything going for me, and it wasn't showing up in the bank. And I sat there at the end of a long day with my face in my hands, just in tears. I was like, how in the hell did this happen? The payroll was due the next morning. And the real gut punch was my mother worked for me at the time, and her name was the first name on the top of the payroll list. And I just sat there and I prayed and I said, if I can get out of this, if I can figure this out, I will make damn sure that I don't get back in this situation again. And I've made it kind of a mission to help other founders, business owners, the people that you work with. We all have a zone of genius and we all have a gift. Unfortunately, money doesn't come with instructions. And I think the reason I was ashamed of this, the reason it was so hard for me to talk about it for so long is I knew more than most people. I had more money knowledge than anybody else in the room. And yet I still fell victim to a lot of the things that I talk about in the book, The Wealth Creation Method. We can put a link to that in the show notes. It made Amazon bestseller a week into launch back in May. And I tell people the book was 25 years of lessons that took about 16 months to bring out. To write. So that's where we are. Where True Wealth Advisors was formed by me and my wife to kind of impart this money, kind of the rules. It's crazy because no one's teaching this. Most financial advisors are not teaching it. Your CPA is there to file taxes. People have fractional CFOs. They have coaches. They have bookkeepers, and people are still failing. The fail out rate as an entrepreneur, business owner it's shameful. And that's why we're doing what we're doing.
Let me ask you a question, man. So obviously you have the knowledge for like making money, saving money, investing, all those things. What would you say were the biggest financial mistakes that you were making, even with your experience back then?
Yeah, it's really simple. There are several different holes or gaps that everybody has in their financial structure. And if you don't plug the holes in the bucket, mistakes, no matter how much money you pour into your business or your business can generate, if it's leaking out the bottom, you're never going to get to where you want to go. Never. So specifically, fragmented advice. One of the things that I experienced and now we teach is when you run a successful business, a 6-figure business, I'm not talking about a side hustle, not a trainer, not an owner that is just getting by. I'm talking about like your legit clients that are listening. They have a bookkeeper. They have a CPA. They may have a fractional CFO. They have you. They have maybe an attorney. They have a financial advisor. They have all of these specialists, and none of the specialists talk to one another. So they're all giving maybe in many cases, they're giving the right advice, but nobody's there to coordinate it. So what ends up happening is you have these fragmented holes in the bucket and you just spin. It'd be like in your world having a trainer that only works biceps. And then you go to another trainer that works chest. And then I got another guy that helps me with squats or lower body. How well would that work? It wouldn't work because it's not coordinated. It's not knitted. So I'd say that is number one. Number two is the advice that most entrepreneurs, me included, for my whole career, most advice that the entrepreneur, founder, business owner is getting is not created or designed for them. It's been created for a working world. It's been created for men and women that have W-2s, that have jobs. So the old adage, we go get an education, go to school, get a good job, start your 401k, put money in the 401k, get the matching, and then you wake up at 65 and somehow you're able to retire. And I looked at that and said, that sucks. Yeah. That's not what I'm about. You're a risk taker. I'm a risk taker. I want to work for myself. So a big mistake is people are getting financial information and building their financial knowledge in a system that wasn't built for me and you. It was not built for your audience. It's built for the guy that has a job that came through the Industrial Revolution, not the entrepreneur revolution.
Yeah, it's a good point. And also, I want to point out, you talk about the revenue trap, right? You've talked about that. And what is that? And how does a fitness business owner know that they're stuck in the revenue trap?
Yeah. So the revenue trap is simple. As a business owner, as an entrepreneur, the revenue trap is when you're believing that success is happening because you're seeing revenue accelerate. I use the treadmill analogy. I call it being a treadmill entrepreneur. So they get on the treadmill, and as you get fitter or more fit, sorry for my English professor.
That's okay.
As you get more fit, what can you do? You can speed up that treadmill faster and faster. You can lift some elevation. You can get to zone 4, zone 5, but isn't there a breaking point? The treadmill will only get you so far. The same thing happens with revenue. And that's the problem all along is we are taught or acculturated as business owners to think what? That revenue is the metric. That's the KPI that matters. And I'm the advisor over in the corner saying, screw the revenue. It's not what you make, it's what you keep. What is it that you want? What is it you're trying to accomplish? What's important about money? And how much are you putting in your pocket? One of my old business partners used to call it jingle in your jeans. But that's not the way we're taught, right? We're taught that revenue, like 6 figures, 7 figures, 8 figures, like we're enamored by revenue, and that's a trap.
And why can somebody make $10,000, $20,000, even $50,000 a month and still not build any personal wealth?
Yeah, because they don't have a system. And that's what I didn't have March of 2009. You have to build a financial structure that allows you to extract money out of the business. The business is not your wealth strategy. I'll say that again. The business is not your wealth strategy. The business owner uses the business as a tool to generate the money that they're going to then extract and buy real estate. Maybe it's the S&P 500 in the form of an ETF. Maybe it's investing in other businesses. Maybe they want to expand. But the business itself can't be looked at as your identity, and it can't be looked at as your wealth strategy. That has to come from the business. So we kind of correlated into what I would call 3 different pillars or 3 different flywheels. The business is there to generate profit. Well, if you spin that flywheel faster and you accelerate profit, what's the counter flywheel? Uncle Sam. So the more you make, the more he's going to take. And if you don't have a coordinated strategy, and here's the big gap, because I know how good you are. You help your audience, your clients make more money. Well, they need someone like me that's a strategist to help them keep more of what they make. Unfortunately, most CPAs are not good at that. Yeah. CPAs or accountants are there to file the taxes and keep you compliant. I always joke and say the accountant, CPA, they work for the IRS. You and I just pay them.
Yeah.
So if they're making more money, they have to learn how to strategize and keep more money. And if they can keep more of what they earn, then they can parlay that into the strategy or the personal wealth. And that's what we designed in our mind. And this is what became our whole business model is if I can extract more wealth out of my business, more profit out of my business, then I can build what I really want, which is not retirement at all. It's what we call work optional. That's the second book that I'm writing. Work optionality. Being work optional means Tobias chooses when, with who, from where, how, with no limits, with all the flexibility and the freedom. That to me, and you said in the kind of the open, my wife and I were fortunate enough to sell both of our businesses to the same firm in 2021. And I was 51 at the time and ready to retire. And I was like, this is no good. This is boring. I hate fishing. I suck at golf. My endurance, we can talk about my athletic pursuits. I unfortunately couldn't do some of that any longer. I was like, I got to find something to do. But it was this idea of I want to be work optional. I want it to be totally on my terms. So for the listener, take the word retirement and just trash it. Don't think about retirement. Think about building your financial infrastructure, your financial foundation and structure around work optional.
Yeah, I like that a lot.
Much better lifestyle.
Yeah, 100%. Then you can still do what you love to do and have some extra expendable income on top of what you already have. And let's make this practical too for everybody. When revenue comes in, how should a fitness business owner divide it in between expenses, taxes, owner pay, reserves, and then investing?
Yeah. So that's actually a very good structural design. There's a very good book a friend of mine wrote, Mike Michalowicz. It's called Profit First. People can pick that up on Amazon. Easy read. Profit First is something that we teach. And when Mike wrote his book, he was talking about compartmentalizing finances, which is what you just described. So when every dollar comes in, you didn't earn a dollar. You earned a dollar that has to be shuttled into operating expenses, tax structure or tax payments, profit, maybe it's future hires, whatever the scenario is. So what we show our clients is how do we take the dollar or the revenue, the income, and how do you properly divide it and compartmentalize it? Because the worst case scenario for us as owners is you get to the end of the quarter and you got to make a tax payment or you don't. Then you get to the end of the year and you dump all this, the shoebox with all the receipts, all the documents to the accountant. And the accountant says, congratulations, you had a great year. And now you got to write a check for 60 grand to Uncle Sam and you're choking on it. You're like, what the hell just happened? And you don't have that money laying around because you didn't compartmentalize tax as a bucket. So that's why that Profit First, it's on Amazon. You can get it. You could read it in a weekend. I highly recommend it.
Yeah.
So that's why that's structurally important. Once to take it one step further, once you have acknowledged that the revenue is not the ending point, money always moves. Money is like water. Money will always find the path of least resistance because the next natural question is, well, I'm making 10, 20, 50K a month. And you said, where's my damn money? It's like, where is it? Well, it's very predictable. The pattern repeats itself. The problem is most people they're not trained to look at that pattern. They're not seeing where the money is flowing. The number one place that money flows and the path of least resistance is lifestyle creep. So the more we make, the more we spend.
Yeah. Yep.
You see it in the bank account and you're like, hey, I'm flush this month. I want to go buy the watch. I want to go buy the car. And it's not just any car. I get it. I've been there. I want the 750. I want the 911. I get all that. But lifestyle creep, if you haven't really looked at it from the lens of what's important about money, is work optional really your goal? Maybe temper down some of the lifestyle crap. It doesn't matter. Nobody cares what you're driving. You care. Nobody else cares.
Yeah. And somebody else recommended that book to me like maybe 5 years ago, Profit First. And so I have that. It's in my cabinet back here. So good read. I have to touch up on it again. And then also like what you were just saying is like the more you make, you start thinking, oh my God, this is so cool. I'm making so much more money. Yeah, you're going to get to that point. But if you are not saving for taxes because you are a business owner now, like it's going to kick you in the ass and you're going to, man, I don't have X amount for taxes, or maybe you have it and it wipes out your savings or whatever it is. So you have to make sure that you're smart and you get somebody like Phil or something, to be able to help you with that. right? And then just a quick question, because I get asked this from some of the trainers and coaches, like what separate bank accounts should a trainer or a gym owner or an online coach have?
Yeah. So if you follow the profit first methodology, and I write about this in my book, The Wealth Creation Method, you don't have to open multiple accounts. It's really very easy. I use a bank called Relay, RELAY. It's an online bank, so no brick and mortar, free. You don't have a lot of fees and a lot of crap, a lot of fluff, but it's an online bank that will route into multiple accounts. So I have all of my revenue hit one income account. And then from that income account, I have a profit account. I have a tax account. I have an operating expense account, and the money then by percentages that I set, and I can help somebody walk through this. You have X percentage, the money comes in, it automatically routes profit, tax, operating expenses, whatever it is, work optional account. You can also use a tool called Sequence. Sequence IO will work with your existing bank. So you can set up this automation. That's the beauty of technology. You can set up this automation. The money comes into your Bank of America or your Wells Fargo, and Sequence is kind of an overlay tool that automatically routes. Those are the things we teach to our clients. And it works very, very well, because if you can take your mind and wrap it around the structural efficiency, it's like going to the gym, and you see this, right? If I go in and I'm doing deadlifts, or I'm, doing something wrong, what's the trainer's job? It's to say, Phil, congratulations, you're doing it wrong. Let me show you the proper way to do the deadlift, or I'm going to do a clean and press, and I'm doing it wrong. I'm going to injure myself. And that's what the trainer is there to do. It's no different in the finance realm. The problem is most people, especially business owners, they don't have the right people giving them the right guidance. So it's like going into the gym and you're getting half the pump, because you're doing it wrong.
Yeah. And what you're saying is so smart, right? If you have an automation or some kind of account where 30% of all your revenue comes out and it automatically goes to taxes, you don't have to worry about it. You don't see it. You're not like, great, I got an extra 10 grand. Let me spend it on this and this and this. No, like it only goes in. And then once all your expenses have been taken care of and divvied out into all your accounts, then you have your profit account. Like that's your fun account where you can be like, okay, now I have enough where I can be like, okay, I can go get my fancy car that I want to save up to, whatever it is, right? So that's a really good tip. I like that. And how much cash should they keep in the business for slower months or like unexpected expenses, would you say?
Yeah, that's a great question. So in the wealth creation method, I outline it as two different things. I call it liquidity layers. Cash is king, folks. It still is. So I look at it in two forms. One, the business should have 3 to 6 months of liquid cash. Now, if you're in a very erratic business, I have a client that owns a massive landscaping company. Well, what happens, and I'm even in Georgia, but in December, January, and February, guess what happens to his landscape work? It slows down. Yeah. So he's in a seasonality type of business. So we adjust his liquidity layer. But 3 to 6 months in the business, 3 to 6 months liquidity layer personally. So what is it that feeds your lifestyle? Because remember, we're all in business for a reason. We're not doing this. It's not our identity to be in business. Our identity is to be who we are to be. The business is the mechanism that supports our lifestyle. So 3 to 6 months of personal liquidity. So just add up all of your need expenses. I break it down further and say you need certain things. You need to pay your mortgage. You need to pay your utilities. You really need to pay for the cell phone, probably not the iPhone 30, whatever we're up to now, but you got to have certain things. Those are needs. And then you have some wants. Like my wife and I, we do go to a pretty high-end gym, a club. It costs us about $370 a month. Could I go to a cheaper club? Yeah, but I'm not gonna. That's part of what we bake into our personal lifestyle. So add all those things up, 3 to 6 months, or just multiply it by 3. I'd prefer 6. And then the business, multiply it by 6. Keep them separate. That's the other thing. People commingle everything. That's why the idea of segmenting like profit first makes so much sense, because people dump everything into a pot. And then what happens? The pot has one big vacuum sound and it like all leaves. It's gone. And don't do that.
Yeah, that's good advice. And you say like your clients average $48,000 in their first year tax savings. So what are some common tax saving opportunities that fitness business owners typically miss?
Yeah, so there are a couple that jump out at me. And average was 48,000. We've seen up to 80 to 100,000 in the first year in working with clients. And it's looking at tax strategy a little bit differently. So home office deduction, the Augusta rule, accountable plans, some type of cash balance plan or retirement plan, although I'd like to rename it work optional plan. Those are 4 right there. How your entity is structured. I would guess a lot of your clients start out as Schedule C, kind of sole proprietorship, and then the progression would be LLC to provide a little bit more liability protection, and then LLC becomes an S Corp. Or LLC filing as an S Corp. And it's funny because a lot of people come to us and they say, my accountant told me I didn't need to file as an S Corp. And I look at their financials and I look at their tax return and I'm like, shit, you just left about $20,000 on the table. It's called self-employment tax. So a lot of accountants, because they're lazy, they don't form the right entity structure from the get-go. So that would be a really easy one for your clientele, for your listeners, is probably that entity structure. If you're just taking in cash as a sole proprietor or Schedule C, there probably is a crossover point. If they're at the 10, maybe less, maybe $7,000 to $8,000 a month mark, if I'm working with them, they're going straight to LLC and filing as an S Corp. And I've got a calculator that I could put their numbers into. In most cases, it's going to save them $7,000, $8,000, $10,000, $20,000 in the first year.
Nice. I love that. And how should they think about options like a solo 401k, a SEP IRA, or any other tax advantage type of?
Yes. So I do not like the SEP IRA. I'll explain in a minute. I love the solo 401k, and I love just plain old taxable brokerage accounts. If you're going to try and get to work optional before the ripe old age of 59 and a half, which a lot of my clients say, Phil, I'm doing fine. I don't want to think about working till I'm 60, let alone 65. If you put all of your money into that solo 401k or any qualified plan, well, the name qualified plan should raise a red flag for everybody. Who's it qualified with? Qualified with our government. So the tax strategy has to be really thoughtful, because if you're putting all your money into that qualified plan, you're trapping it till you're at least 59 and a half. I have a lot of clients that are saying to me, Phil, I want to retire when I'm your age at 55, 56. Maybe it's 50, maybe it's 45. If you trap all your money into these retirement plans, no good. So a taxable account. The other thing you can do is create leverage. You can borrow against your own assets. You can become the bank of yourself. My wife and I were fortunate enough to buy our dream home in Florida down at the beach. And I didn't take out a mortgage, but I also didn't pay cash, because if I'd have taken money out of my trust account, I would have had a capital gains to pay. So I left the money in there and I just went to Charles Schwab and say, hey, I'd like to borrow X dollars against my portfolio. They said, sure, we'll loan you against your portfolio. Well, I didn't have to sell any of my assets. I didn't have to pay a capital gains, but I used the money twice. So I was able to apply leverage to get our dream home in Florida. And we go between Atlanta and Florida, but those would be a couple of quick ideas.
Yeah, I love those. And thanks.
Let me back up. So the SEP IRA, the reason the SEP IRA is popular is it's easy to set up at Fidelity or Vanguard or Charles Schwab, but the structure is wrong for most of us. The SEP IRA, the contribution limits and rules are predicated on how much money the business makes. So that's an issue where the financial advisor and the accountant are not in sync, because in order to maximize the SEP IRA contribution, you have to show maximum profitability in the business. Well, wait a minute. If I show maximum profitability in my business, guess who comes knocking? Uncle Sam. Yep. So think very hard about the SEP IRA. That one I'm not a big fan of for a lot of reasons, because you are just artificially inflating your business revenue and income so that you can make a bigger contribution into Uncle Sam's plan. Maybe, but maybe not.
Yeah. And I also hear a lot of gym owners and coaches that say like, well, what I'll do is I'll sell my business and that'll be my retirement plan. What do you have to say about that?
That's the worst statement that I ever hear from a founder. Now, in full disclosure, I built 2 businesses and I did sell them both, and it changed our life dramatically and our families. So it can happen. But for many people, the odds are against them. According to the Exit Planning Institute, less than 30% of all businesses, small businesses in the United States, actually ever have a sale. Those aren't really good odds. It gets worse. Of the 30% that have a sale, only 11% of the people in this survey, in this study, received what they thought they were going to get from the sale of their baby. So that's why I say your business is not your wealth strategy. Be very careful. That's why you have to build wealth, extract it out of profit, and think about that intentionally. If you get the exit, great. If you don't get the exit, you're not hanging your whole financial future on that. It's kind of a flimsy limb. The other thing I would say for your audience is if they're a trainer, if they're a coach, if their whole business model is them. I had a triathlon coach for damn near 20 years, but I went to him because it was him. His business is worthless without him. It's like a dentist. Dental practices don't sell for much money if the dental practice is built around Dr. Clean Teeth. It's the same thing for your clients, your coaching clients. So be careful with that one. I hate when I hear that because a lot of times it doesn't work out.
Yeah, that's so true. And also, at what point should somebody hire a bookkeeper, a CPA, a tax strategist, or a financial advisor?
Ooh, that's a pointed question. I'd say as soon as possible. Obviously, everything revolves around cash flow. I think if you had to pick one, the bookkeeper is probably the first. It's the least expensive. Don't go cheap on it. Find somebody that can accurately book your transactions. The problem stopping with the bookkeeper is looking in the rear view mirror. The bookkeeper is reporting or recording transactions on things that already happened. So it's important. You have to know where you've been to know where you're going. The problem with the bookkeeper, and I would say the accountant, is they don't help you look further out the windshield with financial leadership, with the type of strategy that's going to build wealth. So again, real difficult question. Probably the hardest question you've asked me, dude. But that's where I would start.
You got to start from somewhere.
You've got to start from somewhere. And I would say have good record keeping. Have a good view of what happened, because then you can start making better decisions looking forward. And then I would say a tax strategist, financial advisor. And in our world, our role is to help coordinate all of them. Now, our advantage is we do books. We have a bookkeeper in-house. We have a CPA in-house. We work with all types of businesses and clients. But you got to start somewhere.
Yeah. And you've also completed 3 Ironmans, 12 half Ironmans, and 9 marathons. Like, how has endurance training shaped your approach to money and also to fitness?
Yeah. I mean, I love talking about this. The answer, it's discipline. It's the same thing you teach same thing you do, same thing that any coach or any trainer lives with. It's taught me the determination, the discipline, the dedication, 3 Ds, all 3 different words. The day you don't want to get your ass out of bed at 5 o'clock to go swim in an open water lake by yourself with a buoy around your ankle, that's when it gets tested. When you don't want to go to the gym and do leg day and you drag your ass there, that's when the gains are made. So for me, I just had this burning desire. The full story, I was sitting on a couch, fat, overweight, not healthy in 1996, long time ago. It's 30 years ago. I was watching the Olympics and I swam in college. I was a collegiate swimmer and I was watching the Olympics. I was like, damn, get your ass off the couch, quit eating the bonbons. And so I started swimming again, and we lived in Knoxville, Tennessee at the time. And I met a guy at the pool. He was an All-American runner at the University of Tennessee, and he sucked as a swimmer. I said, can I give you some pointers? You really look like you're drowning over there in the next lane. He said, sure. So we became friends, and I found out he was an All-American runner. I said, I'm a shitty runner. Could we run together? I'll swim with you 2 or 3 days a week if you'll run with me so I can get better. And then every kid rides a bike when they're growing up. So I was like, yeah, I think I'll try a triathlon. I had been swimming. I loved running. I wasn't good at it, and everybody can ride a bike. So in 1996, I did my first half Ironman and then progressed forward, did the 3 full Ironmans. The end of the story, which I think I shared with you, I had a heart attack in 2020 in the middle of COVID. I had ridden my bike 100 miles training for my 4th Ironman in California, and I had a dissection. My artery, the obtuse marginal, basically had a dissection. It coagulated. It became a 99% blockage. And I finished a 100-mile ride, had a heart attack. So now I'm like, what the hell do I do? I'm laying in the hospital bed. My wife can't come see me. My kids can't come see me. It's in the middle of COVID. I'm laying there and I'm like, well, what is all of this for? Because at that point, we hadn't exited our businesses, but we were doing very, very well. So it changed my perspective. But I think that whole experience, I closed that loop because every athlete, every person that's aspiring to get to another level, it's just a journey. And it's what you learn every single step of the way of the journey, like your situation. I don't know if your audience knows that you're going through a little bit of a tough time with one of the limbs. One of the wheels is off.
ACL, yes.
Yeah. So, but what all of those things tie back to our businesses, don't they? Because it's not the discipline, it's the getting up. What did Sylvester Stallone and Rocky? You get knocked down. That's not how hard you get hit. It's how hard you hit back. And that's the way it was. I became a junkie for endurance. Any of the listeners that know about long distance triathlon, I was on a couple of local podiums, but I was the 11, 12 hour guy. It was dark when I finished. The pros were 8 hours, 9 hours. That was not me, but I was just out there because I was a junkie for digging deep.
Yeah.
Just like a lot of your listeners. That's what makes athletes in particular very desirable as business owners, because you're not going to outwork me.
Yeah.
And I will continue and push forward. Every minute you want to stop, what Ironman taught me is just one more step. Just one more, just one more, just one more. And then you get to the finish line. And every single time I did Ironman, 9 marathons, my goal, to be truthful, was 10 marathons. And I had on my 10th marathon, it was in Richmond, Virginia. And I showed up to the starting line with a stress fracture in my foot. And I was like, if I have to walk, it's okay. I can gut it out. My mindset, probably like you, if I put it in my mind, I'm going to get it done. I'm not going to stop. Well, I played that hand a little bit too much. I got to mile 9.5 and I pulled the plug. I called an Uber and said, it's not going to be 10 marathons. And I'm okay with that.
I've had stress fractures in both my legs and my femurs because I was getting ready for a competition. It is the shittiest pain you're ever going to feel. And
you can't describe it to somebody until you go.
Dude, I was just like, you just want to lay down and cry. Like that's the feeling that you get. And I agree with you on what you said as far as like athletes make some of the best clients in there too. Like a lot of my coaches that I work with, and some do triathlons, and one of them, Scott McDermott, he does Ultramans. He's actually getting ready for the world championships right now. He does Ultramans and ultra marathons, and he's like one of the best in the world. And I'm like, my God, and this dude's in his 50s. He's like 57 years old and looks incredible and like does all these crazy things. So
massive respect there, man. Massive.
Yeah. And I used to compete 16 years. And I think like just having that discipline to compete and be able to turn pro and just have it where like, even when you don't feel like it, you just still get up and do it every single day as you get ready to prepare. And that toughens you up and it creates that unstoppable mindset where like no little thing is going to get in the way. Where if somebody doesn't have those mindsets, they fall off track in there. So that's why it's so important that you have a strong mindset. So I agree. Real quick, I want to do a rapid fire round with you. And this is just going to be quick questions and like just quick 1 sentence answers in here. Are you ready for rapid fire?
Let's go.
Revenue or profit?
Profit all the way.
All day. Business valuation or personal net worth?
Personal net worth.
Emergency fund or investing?
Oh, I think people overanalyze the emergency fund. You've got to have it. I'm going to go investing.
Right. Pay off debt or reinvest?
Pay off debt. That's evil.
One financial metric that every entrepreneur should track.
Ooh, only one. Net profit.
Yep. One tax mistake to avoid.
One tax mistake.
I'm challenging you today, Phil.
That's a tough one. Don't think that your accountant or CPA has got it all handled. You better press or her.
Yeah. And then one money belief that entrepreneurs just need to let go of.
Ooh, one money belief. Scarcity mindset. There's more than enough money out there, folks. You've got to be the one that hustles to gather it.
Yeah, it's like water. It just flows back and forth. And then finally, here's the last one. What does financial freedom mean to you?
It's work optionality. I get to say when, I get to say with who, and I get to say how and from where.
Amazing. Phil, this has been a powerful conversation, man. Loving it. And the biggest takeaway is that a profitable business does not automatically create personal wealth. You need a plan that intentionally moves money from the business into reserves, investments, and assets that can support your future. And the goal is not to stay dependent upon the next client, the next launch, or the next promotion. The goal is to build enough wealth that eventually it becomes a choice. So Phil, where can listeners connect with you and learn more about your work?
Yeah, I think the first thing that I want to offer everybody is what we call the Wealth Creation Scorecard. It's the first step in really identifying the gaps that we were talking about, the holes in the bucket. Because if you can identify where you're leaking, if we can make your workout that much more effective, how much more productive is that time in the gym going to be? Kind of using your world. So wealthcreationscorecard.com. That's wealthcreationscorecard.com. We'll put it in the show notes. It's free. It's 15 questions. It'll take you about 3 minutes and it'll help identify in those 3 kind of pillars or flywheels where you're missing. We could put my web address in there, truewealthadvisors.com, TRU, capital WEALTH, True Wealth, no middle E. What else could we do? We can give them my email. The thing that I've learned, and I'm sure you agree with this because you're a giver, is I made my fortune helping a lot of people make their fortune. Been blessed. And I'm on a mission. The reason True Wealth Advisors exists is to help people, help your listeners stop being trapped on that treadmill, the revenue trap and the treadmill. If we can get just one person into a better financial spot, just like I think you probably, if you could just help one more coach, one younger guy, one younger gal that you see in yourself, if I didn't have to go through March of 2009 and I can help someone not have their evening at the desk with 8 cents, dude, that's worth it to me.
Yeah. That's powerful. And Phil, thank you so much for joining me on the FitBiz Accelerator podcast. And to everyone listening, make sure you subscribe, you leave a review, and share this episode with another fitness entrepreneur who needs to hear it. Thanks for tuning into the FitBiz Accelerator. If you found value in today's episode, make sure to subscribe so you never miss a tip or strategy to grow your online fitness business. And if you're ready to fast track your success, don't forget to check out TNTFitProCoaching.com. Until next time, stay consistent, stay focused, and keep crushing it.